It's the midweek edition of Business Morning. Welcome to the program. I'm Chimeze Obi Iwago.
Great to have you. I'm Ladi Williams. Let's take a look at the news. Oil prices steadied this morning after a steep drop in the previous session following the cancellation of talks among OPEC Plus producers that raised the prospect that the world's major crude exporters will turn on the taps to gain market share. Brent crude was up 3 cents at $74.56 a barrel after slumping more than 3 cents on Tuesday. U.S. oil was up 7 cents at $73.44 a barrel, having declined by more than 2% in the previous session. Energy ministers from OPEC Plus a grouping that includes the Organization of Petroleum Exporting Countries, along with Russia and other oil-producing countries, ended talks on supply policy on Monday. And
divisions between Saudi Arabia, the biggest OPEC producer, and the United Arab Emirates, which opposed extending supply constraints designed to support prices after the fall in demand from the pandemic, were the main reason behind the failure of the discussions. OPEC voted on Friday to raise production by about 2 million barrels per day from August to December and to extend the remaining output reductions to the end of next year. But UAE resistance scuppered the agreement.
And the International Monetary Fund says Nigeria faces a 6-year delay in achieving the Sustainable Development Goals. The Management Director, IMF, Kristalina Georgieva, in a statement titled UN High-Level Political Forum on Sustainable Development, said as countries work to beat the COVID-19 pandemic and ensure recovery, they must also work to give everyone a fair shot at a future that was sustainable, more resilient and more inclusive, which would march towards the Sustainable Development Goals.
According to her, in Nigeria, for instance, because of the pandemic, the country faces a 6-year delay in achieving its SDGs. In Rwanda, it is 5 years. She maintains the IMF raised its global growth forecast to 6% in 2021 and 4% in 2022, adding that it recognized the exceptional and synchronized fiscal and monetary actions by policymakers around the world to cushion the impact of the crisis.
Akwa Ibom state-owned airline Ibom Air has commenced scheduled daily flights to Port Harcourt from Lagos and Abuja. At the launch flight operation into the Port Harcourt International Airport in Rivers State, the Chief Operating Officer of Ibom Air, Mr. George Riesi, has said the airline will continue to keep its promise to schedule reliability, on-time departures, and excellent service to customers on the route. The airline operated the launch flight from Lagos to Port Harcourt with its new A220-300 aircraft. Do take a listen.
This counter at the Muritala Mohammed Airport 2 is unusually busy as passengers take the opportunity of Ibom Air's inaugural flight to make their way to Port Harcourt on a new aircraft, the Airbus 220-300. Once guests are seated, the aircraft is on its way, and in 1 hour, the Port Harcourt International Airport Omagua is in sight. After passengers deplane, the Chief Operating Officer of the airline and the Commissioner of Transport in Rivers State take a tour of the aircraft. Then a special rendition and dance to welcome everyone to the Garden City. And a formal exercise signaling the airline's entry.
The government and people of Rivers State wholeheartedly welcome Ibom Air to Rivers State. It is going to increase on the commercial activity and ease of doing business for people who will be traveling in and out of Port Harcourt.
Port Harcourt has capacity, we believe. The first flight was already about 90% load factor, and the return flight is the same thing. So we expect that Port Harcourt will provide the kind of loads that will justify the use of this aeroplane.
For this Akwa Ibom State indigene and gospel artist, it's good to see a state doing business with great coordination.
They can't drop the ball. So my prayer for them is that they go in that might and improve and just make things better and better.
Other passengers are excited to see another airline on this busy route.
The more the airlines we have, the more the service is beautiful for us. And we're excited we have Ibom Air. I've flown them from Abuja before.
The launch of the Port Harcourt flights from Lagos and Abuja is part of Ibom's Air ongoing expansion program, and this route brings to 6 the total number of destinations for the carrier.
And the 2022-2024 medium-term expenditure framework fiscal strategy document showed that government revenue from January to May 2021 was at 1.8 trillion naira, a 33.3% shortfall of the budgeted amount. This indicates that the recent rise in crude oil prices has not improved the government's fiscal position. Also, Africa is facing a fast-surging third wave of COVID-19 pandemic with cases spreading more rapidly and projected to soon overtake the peak of the second wave the continent witnessed at the start of 2021. Well, to weigh into some of the implications of this is an investment risk analyst with AfriInvest Asset Management, Babajide Atolabi. Thank you very much, Babajide, for joining us on the program. Good morning.
Good morning. Thank you for having me. So
Nigeria's total debt profile increased to over 33 trillion naira, or about $88 billion as at the end of the first quarter of 2021, while debt to GDP ratio settled at 21.1% in the same period. How troubling is this?
So firstly, it is not unusual for a country like Nigeria to have a high debt profile. And this is because Nigeria is a developing country, and debt is a key component of long-term finance for sustainable development. But for Nigeria, the case is quite worrisome because the pace of growth in our debt profile is quite alarming and could lead to a debt crisis if not properly managed in the interim. So over the years, the major drivers of our debt profile, are weak infrastructure, dwindling government revenues, high public expenditure, and the country's exposure to, external vulnerabilities. And, the situation got worse in 2020 due to the outbreak of the pandemic, which saw Nigeria lose both oil and non-oil revenues. In 2021, we had anticipated an uptick in Nigeria's debt profile because the government's revenue projections were quite low, and for sure expenditure remained elevated. So by default, the government would solely rely on debt to finance its obligations. And lastly, another reason that may have contributed to the uptick in public debt is the effect of the currency devaluation on our external debt. That would have shot up our valuation. And going forward, we expect that debt levels will remain quite sticky due to improved domestic and external conditions.
All right, but with this uptick in our debt profile, where do you expect us to settle at the end of the year?
Going forward, I expect that at March we should get an additional 2 trillion in terms of public debt. And currently the Ministry of Finance has delayed its plans to tap into the international debt market. And that is quite understandable because we know how yields are currently trading in that market. We still expect the government to tap into that market because FX reserves are depleting on a daily basis, and we getting external debt will definitely be a good one to show up our external reserves. In terms of domestic debt, we might see continuous uptick. In the first half of the year, the government has been very, very aggressive in terms of borrowing debt in the local debt market, and going forward, we expect that trend to be sustained over the next 3 to 6 months.
Now, notably, the federal government spent a total of 1.8 trillion naira on debt servicing in the first 5 months of the year. That represents about 98% of the total revenue generated in the same period. How do you interpret this?
Thank you. So the best interpretation to this is that Nigeria is a broke entity living from paycheck to paycheck. And I'm sure you agree with me. A debt service revenue ratio of 98% simply means that the government cannot finance other obligations without resorting to debt financing. And a deep breakdown of that number shows us that the issue continues to be weak revenue inflows. The total revenue inflow during that period was about 1.84 trillion. Compared to the expected 3.34 trillion that was budgeted for in 2021. And we also observed that the major shortfall was from oil revenue. And so despite the rally we see in the oil market, despite the parts in that market, Nigeria is unable to benefit from that rally materially because the OPEC agreement continues to place a cap on Nigeria's production numbers. On a normal day, Nigeria is able to produce about 2.5 billion barrels a day, but because of this production cap, Nigeria is currently doing about 1.4 million barrels per day, excluding condensate. So Nigeria is still not, enjoying what it should enjoy on a normal day in the oil market. And this brings up the argument of the country's over-reliance on crude oil, which is largely determined by external push and pull factors. And lastly, before I wrap up on this, surprisingly, debt service cost within the period was 1.8 times the value of capital expenditure from January to May 2021. And that simply tells you the level of unsustainability of Nigeria's debt profile. And with this kind of ratio at hand, sustainable growth is not in sight, and even the next level we are expecting is not even assured.
Yes, what are the risk factors you see here for investment?
The risk factors I see here for investment is that before I think the major risk will come from foreign direct investment as well as foreign portfolio investment, because investors like to look at numbers aside from all other factors, and a government that is struggling to pay that is struggling to use all its revenue inflow to pay debt, and then that tells you that the debt sustainability risk is high, and investors might be wary of this. And in terms of FX risks as well, which has dominated the investment climate for a number of months back, investors will be quite worried because inflowing your dollar into Nigeria at this point, you may be a little bit risky because the fact that investors might not be able to get their currency as when due, and the likelihood of a currency devaluation, which continues to fuel analyst sentiment in past 6 months, that might also contribute to a major risk factors and investment managers might be on the outlook for. So on the large side, the major risk here is Nigeria's debt sustainability risk in line with the foreign currency risk.
Now, is there anything the government could have done differently to avert this debt scenario? And what are the realistic measures that can be put in place to remedy the rising debt profile in order to avoid the Sudan and Greece debt crisis scenario?
Yes, so I think the government may have to handle the issue from both the revenue generation perspective as well as our high public expenditure profile. I mean, the major reason why we borrow so much is because we earn so little and we have a lot of things to cater for. In terms of revenue, the Nigerian government will have to increase the adoption of market-friendly policies that will drive investment in the oil and non-oil sector. Policies that will attract capital flows into the upstream sector. That way we'll be able to drive our production numbers and then we'll increase output. Also, policies that will also enable businesses to thrive in the real sector. And then at the end of the day, these companies will be able to pay more taxes, and then indirectly the government is also getting good revenue inflow from that angle. In terms of expenditure, the government needs to free up resources. By cutting down the cost of governance. A lot of talks have been done around this over the last couple of months. Adoption of digital infrastructure in the MDAs and also tackling the issue of corruption. And lastly, in terms of capital projects, we know that many developing countries like to borrow funds in order to drive infrastructure projects in their economies. Since infrastructure requires large finance, we believe that the FG can adopt alternative financing methods, such as the BOT model, which is the build, operate, and transfer model. And this model has been successful in countries like China, India, Ethiopia, and even the case of Nigeria, because this model was what was used to build the Ibadan-Lagos Expressway as well as Lekki Toll Plaza. So there are a lot of alternative financing methods that the government could also look into in order to drive infrastructure, rather than going to the debt market immediately. And lastly, the Nigerian government will be encouraged to save more in terms of reserve. Nigeria has about $2.5 billion in its sovereign wealth fund, while a country like Kuwait that has less than 20 million citizens has about $750 billion dollars in its life after oil fund. So funds like this help you to absorb shocks whenever there are national crises or whenever there are external vulnerabilities. So the country will not necessarily have to, continue to accumulate debt.
All right, interesting. But the report also indicated that interest payments on Ways and Means was at 480 billion naira as at May. What's your take on this?
So it is expected because lately we've been observing that the CBN has been acting at the last resort to the federal government lately by providing ways and means to the government. And then in 2020 that really happened a lot because Nigeria could not tap into the external debt market. So the CBN was more of like the major supply aside from the money that was raised from the local debt market. So it is expected that since the government was able to accumulate a lot of debt from the CBN in 2020, interest payment is also expected to rise. And we are likely going to see that trend continue over the next couple of months. And trends like this would obviously affect our bottom lines because that way, when you pay a lot of money on interest, you have little or no money to finance capital projects. You have little or no money to take care of recurrent expenditure, and you have little or no money to drive the required change and growth that Nigeria is expected to do over the short to mid-term.
Now, should we say is a situation now that a nation is debt trapped?
I wouldn't say we're in a debt trap yet because looking at international standards for developing countries, the IMF has signaled that a debt to GDP ratio of 25% is a good benchmark for developing countries. And currently, as we speak, Nigeria's debt to GDP ratio is around 21.3%. So we are still doing comfortably well in terms of debt profile. Well, I think the major issue lies with our debt servicing cost. When you compare the amount of money we generate as revenue and then the amount of money we pay out as debt service, debt interest, basically, that is where the issue actually lies because that model we run is not sustainable. Because what it will at the end of the day, what it will make the country continue to borrow more because our fiscal deficit will continue to expand, given the fact that the government does not have resources to take care of projects like I've mentioned. So our fiscal deficit will continue to expand, and then the government in the next 2-3 years will be exposed to further borrowing, both in the international market and in the local market. And then at the end of the day, the issue of debt trap may now begin to arise. But currently, as we speak now, our debt profile is still quite okay when compared to our peers in the emerging market and also in the BRICS region.
All right, but with a potential third wave of COVID-19 in sight and economies trying to spend their way, through the crisis and drive towards global vaccination, how do you see this impacting Nigeria's debt profile?
Largely, I think it will affect our debt profile negatively because in an instance where the government is forced to adopt another lockdown, economic activities may come to a total halt, and then the significant recovery we've seen in the fourth quarter of 2020 and first quarter of 2021 might actually get eroded. And then, the government might be forced to, expose themselves to external debt, like I've mentioned, because if we have a third wave of COVID-19 pandemic in SSA, it will largely affect commodities prices, yes. And obviously, oil may not be completely left out of that scenario. And if we're having any major shortfall or in oil prices, and and coupled with the fact that Nigeria is not producing oil at a very comfortable level, that might be a double whammy effect, and then the country may eventually lose out on its revenue generation. I mean, historically, our revenue generation has been poor, and if we continue to have that kind of trend, coupled with the third wave COVID-19 pandemic, it may even become even worse, and then the government will be forced to tap into the debt market. And what we might see in the local fixed income space is that if the government should increase its aggressiveness in that space, yields may be forced to rise for that, because recently we've seen a recent drop down in fixed income yield. That the aggressiveness from the government may lead to a rise in yields in the local environment, and that may not be so friendly for investment managers who are actually going long.
Thank you very much, Babajide, for your time this morning with us. We do appreciate it.
Thank you very much.
And after the break, FX Commodities Market is next. Do stay with us.
Welcome back. For FX Commodities Update now, the exchange in the week ended July 5th. There was some green in the Commodities Exchange Board, except the FX Commodities Index, which declined by 0.20%. For details now, let's bring in Michael Martin. Hello, Michael.
Hi,
Good morning,
Ladi.
Michael.
Good morning.
Thank
you for having me once again.
Great to have you. Bring us up to speed with market activities in the week under review.
All right, Ladi, thank you very much. So if you look at the commodities market summary in front of you, you would see that the total value of transactions traded on the exchange went up by a factor of 100 from around 227 million naira to close to trading week at 23.06 billion naira. The total number of contracts traded on the exchange also went up by a factor of 67.84 from around 7,880 deals to close the trading week at over 500,000 deals. The number of deals executed on the exchange also went up by a factor of, by 8.57% from 35 deals to close the trading week at 38 deals. The AFEX Commodities Index is, however, down slightly by 0.20% from 471.88 to close the trading week at 470.94. The AFEX Export Index is, however, up by 2.38% from 171.77 to close the trading week at 175.86. With regards to the volume of contracts traded on the exchange, there was a general increase across board, with the biggest increase coming with maize, which traded up from 1,514 contracts last week to 311,000 contracts this week, and also from cocoa, which traded no volume last week, to trading over 206,000 contracts this week. And last but not least, we have sorghum, which traded 929 contracts last week and trading over 16,000 contracts in the week under consideration. With regards to the price changes on the exchange in the week, we saw the top gainers being cocoa, which gained 17.62% to close the trading week at 108 naira, 976 naira per contract, 976,000 rather per contract. And we also saw a slight increase in the price of sesame, which went up by 0.65% to close the trading week at 48,117 naira per contract. With regards to the red that we saw in the week under consideration, we saw sorghum fall by 27.51% to close the trading week at 17,452 naira per contract. Maize fell by 17.20% to close the trading week at 19,859 naira per contract. Ginger also fell by 12.97% to close the trading week at 96,650 naira per contract. Soybean also fell by 9.35% to close the trading week at 31,569 naira per contract. Paddy rice and cashew also fell by 7.30% and 2% respectively. And last but not least, with price, we have the fair trade exchange traded commodity, which fell by 4.42% to close the trading week at 13,892 naira per contract. So those are the price changes and the volume traded that we saw occur on the exchange in the week under consideration.
So what are the biggest determinants of pricing on the exchange?
Thank you very much, Jamezia, for that question. So usually when we're computing the final closing price for exchange for trades that occur on the exchange, we're usually taking into account two major types of trades. So first off would be the OTC transaction, which is over-the-counter transactions, and these are essentially physical transactions designed for delivery, and they usually occur at our warehouse level, and they occur at multiple locations, usually around the same time. And secondly would be the spot transactions that occur on our tech platform, which is COMEX. So that would ideally be the biggest determinant of pricing of the closing price of commodities on the exchange. Secondly, would also be the logistics of moving that commodity from their source location to where they're ideally needed. So what we do on the exchange is that we normalize the prices of the trades that are executed on the exchange as per where you see the highest demand volume, which is ideally would be for Southwest, for grains, and then for export, and then for export, you see other locations too. So first off would be the trade. Second of all would be the logistics. So ideally, if you see a structural defect in logistics that is moving commodities from one place to another, that could also influence the pricing, the final closing price of commodities on the exchange. Lastly, but not least, would also be the open market price, which sort of serves as an indicative price for all the trades that are executed on the exchange. And this is more so important from a comparison standpoint. So the investors or other participants that are taking trades on the exchange can sort of compare where prices are and look to either take arbitrage if and when that opportunity presents itself.
All right, are there any price limits or controls when, trading commodities on the exchange? And if there is, can you explain, the function?
So currently there are. So if you look at our spot board, if you look at the spot transactions that occur on the exchange, there's currently a 10% ban that sort of provides a limit on where on the kind of pricing that you can put on the contracts that you're trying to either buy or sell. And this is essentially similar to the limit up and limit down functions that you essentially have with the futures market in the international space. With regards to the OTC transactions, there aren't currently any sort of control. What you tend to see in the commodity space is that usually for trades that don't meet a particular threshold, say 10 or 20 metric tons, those trades would essentially not be recognized. But as regards to controls, those are essentially we currently only have controls for spot contracts. As regards to what their function is, I think it's pretty obvious, and I think it's essentially to provide to protect against market volatility, right? And I think it's incumbent for everybody to understand that when they're investing in the commodity space, we at the other hand are trying to control as much volatility as possible, because of course this is the commodity space and not the crypto space. So it's not essentially a get rich quick scheme. You're not going to get rich tomorrow, but you might get rich in 6 months. So we put those price controls there in order to help us control the volatility in the market.
I don't want 6 months. I want 3 months at least. Okay, so tell me, what's the status quo with the agri-financing landscape, and what do you think the ideal should be?
Wow, that's a very important question. So look, the status quo in the agricultural space is being that, first off, there has been limited financing. So if you look at the historical figures, right, the sectoral credit allocation to agriculture is usually ranged between about 4 to 5%. That's an extremely small number for a country who is trying to become food secure and who's trying to essentially encourage investment in the agricultural sector. The second issue, which is sort of what we have seen at the status quo, is the fact that we don't currently have systems and infrastructure that recognize assets that exist within the commodities space or the agricultural space by extension. So ideally, what you should have, right, in any sort of financing ecosystem is the fact that you ideally should have systems and infrastructure that recognize assets, right? So take, for example, the commodities landscape in comparison to the oil landscape, whereby people that have assets in that industry can essentially access collateral and other types of financing based off of either the amount of oil that they've already gotten out of the ground, or the one that they're about to drill out of the ground, right? So that kind of asset recognition doesn't currently exist, at least not in enviable measure. That kind of asset recognition doesn't currently exist within the commodity space. And what it does is this, right? When assets within the commodity space are recognized, it allows whatever player or whatever participant is currently involved in that transaction to use those assets as collateral for loans or other types of financing. I think that's about the biggest issue that you have. That should be in place, right? Another thing would also be for us to have more public and private partnerships, to sort of drive up that financing to at least double digits. So historically, the agricultural sector has sort of been seen to be the public space, and by public I mean the federal government. So a place where the federal government sort of plays, by providing subsidies and a lot of other strategic programs and all. But what we do need is a lot more private players participating across all the different parts of the value chain to sort of increase that credit that we allocate to the agricultural sector to at least double digits as we see in other developing countries.
But what structures allow us to achieve this ideal outcome?
I think when you think about the commodities market, I think there are three major structures that ideally should be put in place. First off is knowledge. And when I say knowledge, I mean information asymmetry, right? And this is important because we want every single participant that plays in the commodity space to have full visibility over what is going on, right? And that's regardless of whether or not you're a farmer, you're a processor, or you're somebody with a storage facility, or you're somebody who's also looking to invest in the commodities market. So you want people to have as much information about what they're investing in, how the investment is going to generate risk, or how their investment is going to generate a return, and what the incumbent risks or what the attendant risks are, whatever it is that you're investing in. I think that's most important. The second would also be technology, right? And I think technology is important in two ways, right? First off, it provides visibility, right? So take, for example, 10 years ago, if you had a farmer in Zamfara State and you wanted to monitor his farming activities or what his exercise was or what he was cultivating for time, you couldn't essentially measure that, right? Because that technology wasn't available, right? But right now we have that technology that sort of helps us monitor what the average farmer activity is, and we can then use that data to predict, what their production volumes will look like at the end of the season or during harvest, right? Secondly, would also be, with regards to technology, would also be that technology helps us provide significant economies of scale, right? So look at some of the solutions that we at AFEX look at some of the solutions that we've been able to provide to the ecosystem. What technology allows us to do is that it allows us to scale those solutions, to more and a larger number of people, which would significantly reduce cost, right? The third and certainly not least structure that needs to be put into place is we need to have more art infrastructure. And I would just mention too here, we need more storage infrastructure to sort of propel more production volumes, because ideally what you would see in other countries is that you would have a storage capacity that is at least 75 to 80% of what the total national production volume is. But here in Nigeria, that number is usually closer to around 0.5 to 1%. Secondly, would also be transport networks, right? So you need better transport networks to sort of facilitate transactions from one place to another, providing ease for people that want to do business within that space. So those ideally would be the three structures that should be put in place.
Okay, Michael, a quick one before we let you go. Why is it hard to get capital market invested in agriculture, and which instruments can agri-SMEs leverage on in raising capital? A quick one.
So look, we can look at a couple of different factors, right? But I think the most important would be data, and it's irrespective of the type of investor that you are, whether or not you're an impact investor, or whether or not you're an investor that is looking to take advantage of price increases in the market, right? So as an impact investor, you want data on the number of farmers that your financing is reaching. You want to know what that impact is on the farmer that you provided finance to, and a lot of other data points. And as an investor too, who's looking to take advantage of that price appreciation, you want to know, you need data to sort of assess what your risks are, and maybe most importantly to that type of investor, what your potential return could be, right? So I believe data would be the biggest issues with getting financing or capital into the agricultural sector. With regards to the type of financing that we currently have available to agri-SMEs, so it depends on the type of SME that you are. So if you're an SME with farmers under your network, we currently have the ASP program, which sort of provides inputs to agri-SMEs, which they can then distribute to their farmers. So it's a way by which we can empower agri-SMEs to essentially do the same thing that we do, right? So if you're an SME that is interested in international exports, or you have export products under your purview, you can take advantage of the trade finance note that we currently also have on the exchange. And if you're also lastly an agri-SME who is a processor, you can take advantage of the asset back, which is the ABCP, the asset back commercial paper program, which sort of helps you provide working capital financing over the course of your entire trade year. So those are some of the financial products that we currently have available for agri-SMEs that are looking to take advantage of the financing that we have available.
All right, Michael, always great to talk to you. Well, you didn't give us your details, your website and all of that.
So yes, if you want to get involved in the commodities market, you can always go to our website, which is www.afxnigeria.com. And if you also want to start trading commodities, you can download our app, which is available on iOS and Android.
All right, Michael. Always great to talk to you. Thank you so much.
Thank you, Ladi, for your time.
All right. All right. We'll take a moment now. Welcome back. Now for the opening call to the market, here's Anyete Edet. Well, Anyete, we saw more gains in the market.
Yeah, good morning, Ladi. It smiles all the way for the equities market in four trading days within the new month. It's still winning ways across board for the market. Yesterday, we increased the previous gains by another wider margin, more than half of a percent. Recorded in the value of the all share index, which has it recently regained its 38,000 points. And then of course now for the equities capitalization, it also went back into the 20 trillion naira mark. It gained more than 103 billion naira at the close of Tuesday's trading session. So now you can take a look at it. 20.026 trillion naira. That's what we gained. All share index up 0.52%. And well into that 38,000 psychological level. And that came due to the increased interest for Seplat, as well as some key banking sector index. Of course, that's the bargain hunting from those high-value equities pushed the month-to-date gain to about 1.4%. And then, of course, it reduced the losses that we had to minus 4.6%. Okay, so now when you take a look at it, that's it. Banking sector index, 3.29%, but the biggest one was from the oil and gas sector. Like I mentioned, Seplat did that magic. But the lone loser there was insurance sector. Of course, it's always moving in inverse position, because when all the other counters are in positive, it always moves for its own reason on the other position. So, of course, we also had an increase in the value of transactions. We had volume of transactions was up by 2.2%. Value was also up, but the deals was down. And then, of course, that just shows you that investors are really coming back into the equities market. But now to bring us up to speed with the market performance in early trading for midweek, let's join Mohamed Kaide, who is head of dealings at APT Securities and Funds. Thank you for joining us, Mohamed.
Good morning. Thank you very much.
Yes. So I'm sure you traders are smiling, especially with the very first few days of July, which we termed as a positive start, especially for the second half of the year, the third quarter, and then, of course, the first full week of the month. So now, can you bring us up to speed with what's going on at the NGX?
Thank you very much. It's a pleasure to be on the program with you. And I always tell and say on this program that really in the market, we see this market is going to be on the upward trend. And what we are seeing now in the market is showing exactly what we have predicted earlier. Though we are expecting the market to close on the green at the end of the half year, but what we are having now is now showing what we are expecting. Market for now is now a bit more liquid. You can see the activities in terms of volume and the value traded in the market keeps growing up, and also the numbers is now favoring the positive sentiment. So what is happening in the market now, you see we are expecting it to continue going even throughout this week. We expect the market to continue in that regard. So now what we are seeing now is that expectation of the market in the report of half year is growing, because people are seeing that there's likelihood that from every indication, the report that they are going to declare at the end of half year is going to be favorable. So, and you see fundamental in the market, there are two news that affect our market. We have market fundamentals and we have economic fundamentals. Though economic fundamentals at this point is not very robust, market fundamentals are dictating, it's not now dictating the movement of the market. So
all the stocks that we have in the market, they have good results, good earnings, and also most of them are undervalued. So at this time, you see markets growing at this rate going forward into the future.
Okay, so now with that being said, in a couple of days from now, we'll be having the inflation figure for the month of June, as well as, the lookout for the MPC's meeting. So is there anything for investors or traders to fear or to be concerned about in the coming days?
Looking at what we are expecting from MPC meeting, the committee is trying to look at how inflation is going to behave before they can dictate whether they are going to adjust the rate or whatever. But as it is now, we saw the inflation coming down, and even those that have predicted, they believe that the inflation will likely come down too. So in that regard, even though if the MPC wants to continue, wants to sit, they are likely going to maintain the rate the way they have been doing for a period of time. So now the inflation figure that we have now, as I've always opined in this market, that the inflation rate we have now, any investment that you do that is not inflation adjusted rate of return, you are not making the real return. You are not making the real profit. So your investment needs to replicate that. And the only market or the only investment vehicle that you can use to make sure that you generate this inflation rate adjusted rate of return is the equity market. You look at some stock for now, look at assets. In the last 2 months, it has generated more than 18% of inflation. So market is the one that can generate this kind of rate of return. So we're expecting people to the investor to look out to capital and equity market for them to generate the necessary return they want to their investment.
Okay. Thank you, Mohammed, for giving us that information. So that was Mohammed Kaide, the head of dealings at APT Securities and Funds, Ladi. Our favorite market, the equities market, of course, it's a market across board, and it's maybe a market, the toast of investors. Yeah. So that's it, Ladi.
All right, Nita. Thank you so much for that update. Anyway, we'll take a quick break now. When we come back, Business Morning continues. Do stay with us.
And for some developments in London, we have Juliana. Good morning, Juliana. Well, starting off on the data front, UK house prices dropped for the first time since January as stamp duty cut winds down. Any more details from the Halifax release?
Yeah, it's a surprise, Chimose, because we've been speaking about the housing market boom here in Britain for months and months. But according to Halifax, the mortgage lenders index from today, it does show for the first time since the beginning of the year that there has been a decline in house prices. So annually, house prices are still very, very high, £21,000 higher than they were this time last year, which works out at about 8.8%. But month on month, between the month of May and June, house prices, according to Halifax, have dropped 0.5%. Economists have been mulling about this, and a lot of them have put it down to the end of the stamp duty holiday or the tax reduction holidays. If you're buying a home up to £500,000 for about 8 or 9 months, you haven't had to pay this tax. That's been scrapped now. That's been pulled away, and we are slowly starting to see the bubble burst. Good thing, of course, if you're trying to get on the property ladder, which is incredibly difficult here in the UK. But of course, it does ask questions about where the housing market will start to go towards the end of the year, particularly when we are expecting unemployment to rise in September, when the furlough scheme, which is still supporting about 2 million Brits, does come to an end, and consumer confidence will remain dented.
And Heathrow is to provide fast-track lanes for fully vaccinated arrivals. What's the strategy to make this work?
Well, only time will tell, Chimose, because we know that the UK travel industry is in pretty much a turmoil at the moment. Lots of false starts. You know, you can travel, you can't travel, green, red, blue, yellow. But Heathrow are trialling this new scheme where it will allow any passengers coming back into the UK, if you have had 2 vaccinations, you will be able to pass through the border pretty swiftly. There have been lots of complaints and some pretty extreme pictures showing passengers staying at borders for hours upon hours upon hours. Many passengers, neck to neck with people that are quarantining or people that are coming from destinations with high COVID-19 rates. So what I think bosses are trying to do is to show the government, prove, particularly to the Transport Secretary, Grant Shapps, that this system can work. They're kind of going ahead of the government in anticipation that perhaps from July the 19th, anybody who has had 2 COVID vaccination jabs will not have to self-isolate if you've come from an amber-listed country. There are so many rules and regulations that are very, very confusing, but Heathrow bosses are going to be trialling this today. If it does become a success, then perhaps it will be passed around other airports in the UK and potentially across the world.
Interesting. All right, we'll get more updates from you later on Business Incorporated.
Thanks, Jimmy.
And to crypto market now. Ladi, well, I saw something today about some kind of fake stocks being listed on blockchain. What's that all about?
Well, there's a couple of innovators looking to bring traditional stocks, into the blockchain. So some crypto exchanges have actually listed stocks like Tesla and Apple. But the warning now is if you buy these stocks on the blockchain, you don't actually own equity, in the real stock. So that's what that's about. Well, let's look at the market today. It's Bitcoin is in the red today, but we have Ethereum, BNB Dot, and a couple of other altcoins actually in the green this morning. Market cap, $1.47 trillion, up about 0.71%. And 24-hour volume traded, the total crypto market, $80.11 billion, up 12.92%. Bitcoin dominance, 44.22%. Look at price of Bitcoin, $34,758 at 8 a.m. this morning. 24-hour volume, $28.55 billion traded. Let's bring in Solomon Amunde now. Hello, Solomon.
Good morning, Ladi. Good morning, Ladi.
Good morning, Solomon. Great to have you. Well, we see as Signum becomes first bank in the world to offer Ethereum 2 staking. Tell us about this Ethereum 2 staking.
Yeah, it's actually a fantastic development. Signum bringing this to the traditional banking users and investors, because clearly we know most persons don't like to interface with cryptocurrency assets based on they feel it's extremely risky and they feel the current world doesn't accept it yet. So seeing Signum, a bank that has been certified, bringing Ethereum staking is just it's a new system where Ethereum is trying to move from proof of work to proof of stake. And so far, we have over 6 million Ethereum being staked so far. And stakers earn rewards passively based on their staked amounts of Ethereum. They earn as high as 8 to 10% annually. Now, Signum is bringing this to their users via their banking services, and they are giving as much as 6 to 7%, about 6% APR annually. That's annual profits returns. That's what they're giving. Annual percentage returns, rather. That's what they're giving to their users that choose to stake Ethereum via their bank.
All right. Solomon.
Yeah, I'm with you.
Okay, yeah. So do you think other banks will follow suit in offering these services?
Yeah, I think it's only a matter of time, because so far so good. The returns we get in fixed deposits in our traditional banks these days is extremely poor. It's less than 2%. But with the DeFi ecosystem, if the banks can be able to harness the power of DeFi, able to give their users and customers as much as 6 to 7% APY every year, and they can even go as high as 10%, which would go a great deal, because currently it's not really looking good.
Okay. All right, Solomon, but the word on the street is DeFi 2.0 is coming this summer. What's that about?
Yeah, the DeFi 2.0, it's basically some platforms they choose to call theirs DeFi 2.0, where they've been able to find better ways to give better yields their consume to their customers, and the yield here is better returns to their customers. And some, they found other ways to reduce the risk. So the 2.0 is more like they have been able to update or upgrade their systems to be more secured, more robust, and offer...
So when I see a DeFi season, is it possible?
We are 100% still in a DeFi season. I mean, right now, the market would soon flip. Ending of this month, next month, we should see the market flip to green. So 100% NFT season and DeFi season.
NFT DeFi. Okay.
Yeah.
All right, Solomon. Thank you so much.
All right.
All right, let's look at the 4-hour chart for Bitcoin. It is doing well this morning. We have a bullish MACD cross. It's crossed the middle Bollinger Band this morning on the 4-hour chart. So Bitcoin is looking good. A couple of altcoins actually looking strong this morning. We see KuCoin shares there. KuCoin shares just launched their own community at blockchain, just like Binance chain has theirs. And one, it's up there 22%. Mana, one of the NFTs, up 19%. And we have Nexo, $1.71, up 13%. Chimmy, it's not looking bad for alts this morning.
Oh, well, with DeFi season, NFT season, just wondering what altcoin, if I have to, get into this market, I should be looking at. I mean, we are in the midweek.
Yeah, well, I have my eyes on ZRX.
ZRX. Okay, but this is not a financial advice anyway. If you have to play, of course, you have to seek professional advice. It's on that note that we draw the curtain on today's edition of the program. Thank you for watching. And don't forget to join us at 1:30 this afternoon for Business Incorporated. I'm Chimize Obi Iwagu.
And I'm Ladi Williams. Thank you for watching.